So let me look at three main drivers of the gold price, three things that would indicate that the price of gold is going a lot higher and getting to the $10,000 an ounce. The first one is technical. So we're in the third great gold bull market in history. And you say, well, wait a second, history? It goes back, five 7,000 years. How come it's only the third bull market? Well, the answer is that until 1971, gold was just money. You didn't have to say, what's the ratio or what's the price. It was a form of money. The IMF took subscriptions in gold. Gold was in the reserve positions of major central banks. So it wasn't until 1971 when President Nixon broke the last link between gold and I'll call it paper money or fiat currency, that the price of gold could fluctuate enough that you could have a so-called bull and bear market. So I start from 1971. So we had a bull market 9 years, from 1971 to 1980. Gold went from $35 an ounce to $800 an ounce. That was a 2,100% gain in 9 years. Then it was flattish, trending down for a very long period of time, almost 20 years in the 80s and 90s. Finally hit bottom at $250 an ounce in 1999. That's when the second great bull market began. And from 1999 to 2011, gold went from $250 an ounce to $1,900 per ounce. That's a 670% increase over 12 years. Then a very sharp bear market from 2011 to 2015. The price of gold collapsed over 50%. You can pick the exact day. I'll tell you the day, December 16th, 2015. That was the bottom of the bear market and the beginning of the third great bull market. And we're in that bull market today. The price of gold, it peaked, interim peak recently, August 8th, 2020. It hit $2,060 an ounce. That was more than double, just about double from the end of the last bear market, the beginning of the new bull market. Where is that going to go? So what I did, if you take those numbers, first bull market, 9 years, 2,100%. Second bull market, 12 years, 670%. But just take a simple average of the two. That would come to a 10-year bull market where gold goes up 1,385%. So that would put gold at $14,500 an ounce in 2025. So there's one way of analysis, a technical analysis, but if the current bull market is simply the average of the prior two, not bigger, not better necessarily, just the average of the two, gold's going to hit $14,500 an ounce in 2025. What if you had a gold standard? Now, I'm not saying we're going to have a gold standard. There is not a central banker in the world that wants a gold standard. I can assure you that. But they may have to go to one. There's a loss of confidence in the dollar. And by the way, we're not going to live in a world where the dollar crashes and everyone says, "Get me some euros." I mean, that's nonsense. If there's a loss of confidence in paper currencies, such as the dollar, starting with the dollar, that loss of confidence is going to apply to all paper currencies. It's not going to be one. The only thing that's going to go up in that world is gold, because gold is not a fiat currency. It is a form of money, but it's not a fiat currency. So the idea that the dollar is going to crash 50%, the euro is going to go up, that's ridiculous. So major currencies trade in a range. Yeah, they can go higher or lower, but they trade in a range. They don't go to zero like Hertz. They don't go to the moon like Apple. They fluctuate in a range. That will continue to happen. If you're a currency trader, an exporter, yeah, you care about that. But if you're looking at what is sometimes called the Great Reset or monetary collapse, it's going to affect all currencies at once. And at that point, central banks may have to go to a gold standard to restore confidence. Now, people say, well, there's not enough gold in the world. Maybe once upon a time there was enough gold to support commerce, but there's not enough gold today. Numbers are so much greater, GDP so much greater, commerce, trade, foreign exchange trading, et cetera. Sorry, there's not enough gold. Well, that's nonsense. There's always enough gold. It's not about the quantity of gold, it's about the price. So what you have to ask yourself, what is the implied non-deflationary price of gold in a new gold standard, or even an approximation of a gold standard where you were trying to restore confidence? Well, the way to do that, again, the good part of this is the math is also the seventh grade math. We don't need integral calculus for this. The global M1 money supply today is about 32.3 trillion, approximately. Now, the amount of gold, official gold, we know that number is 34,000 metric tons. So again, this is all publicly available information, none of it's secret. So you got 32.3 trillion of M1 money supply, 34,000 metric tons of gold. How much gold backing do we need to support the money supply? Now, this is a subjective judgment. I don't think there's a definite number. So I'm going to use 40% as a conservative assumption. That's high relative to some most historical gold standards that have worked. So the math is simple. Basically, you take 32.3 trillion, you need 40% of that, which comes to 12.9 trillion. So you need $12.9 trillion worth of gold. You have 34,000 tons. So what's the price per ounce for 34,000 tons to get to 12.99 trillion? Well, the answer is $12,000 an ounce. So take your 34,000 metric tons and do $12,000 per troy ounce, and that comes to 13.2 trillion, which is more than enough to get you to a 40% level on 32.3 trillion. So that's called the implied non-deflationary price of gold in either a gold standard or a shadow gold standard, is some way that central banks are looking to restore confidence in the paper money. So that gets you to $12,000 an ounce. The third method has to do with confidence, specifically confidence in the dollar. Right now, the U.S. debt to GDP ratio is about 130%. So take the national debt divided by GDP. What's that number? Well, the answer is it's 130%. Debt is about $32 trillion and GDP is about $24 trillion. There's very good evidence that, a ton of research, empirical data, that says when your debt to GDP ratio is above 90%, the Keynesian multiplier drops below 1. A 30% debt to GDP ratio is considered very comfortable and sustainable. 60% is a little high. That's where Angela Merkel, gets nervous. 90%, you're through the looking glass. Well, the U.S. is at 130%. That means we cannot borrow our way out of a debt crisis. So you just can't do it. In fact, the more you borrow, the worse it gets. You're digging a deeper hole for yourself. So what would it take to reduce the debt to GDP ratio? The American way is inflation. You basically, it's like holding an ice cube in your hand and watching it melt. You inflate the debt away. So the nominal value of the debt can be unchanged, but by diminishing the value of the dollar, and that's what inflation is, that debt to GDP ratio falls into line. So it would take a 75% devaluation of the dollar to get the debt to GDP ratio from 130% to 30%. And people will go, that will never happen. You'll never have a 75% devaluation. Well, we've had this several times. What do you think happened when in the 1970s, when gold went from $35 an ounce to $800 an ounce? That was an 80% devaluation of the dollar measured by weight of gold. So something similar would put gold at $8,000 an ounce. Gold at $8,000 an ounce would be a 75% devaluation of the dollar measured by weight of gold. So I just gave you three methods. One was a technical method, one was involved money supply, and the third one was involved managing the debt to GDP ratio. If you take the simple average of all three, so one had a $14,500 per ounce price target, one had a $12,000 per ounce price target, one had an $8,000 per ounce price target. The average of the three is $11,500 an ounce. So I'm not forecasting that any one of those three things will happen. All three of them could happen. The last one, the inflation scenario, is extremely likely to happen. We'll talk about that in a minute. But all of them get you to about the same place. And again, $10,000, $11,000, $15,000 for a range. I would really say there's a range from $10,000 to $15,000 per ounce, but just take the low end of the range, $10,000 an ounce. That's where we're going.